One of the questions I get asked the most is what should you put in your portfolio, ETFs or single stocks, or maybe a combination of both? And especially as a dividend investor, we only have a handful of really good, strong dividend ETFs here in Australia. Now, some people swear by ETFs because it's a simple way to invest, and others prefer to buy single stocks because you can curate your portfolio a lot easier. So hopefully by the end of this video, you're going to be able to determine what is right for your portfolio. Should your focus be on ETFs, specifically dividend ETFs, or maybe you prefer, like I do, going for single stocks, or maybe you want a combination of both. There really is no wrong answer here. But let's look at the numbers and we'll analyze what VHY, which is the most popular dividend ETF here in Australia, how that's performed over this year. I'll compare that to holding the top 10 companies and we'll see who's performed the best in terms of both growth and the amount of dividends that they've paid out. Now, when you're creating your own portfolio, you're not just going to copy the top 10 of an ETF, although you could do that. There's nothing wrong with doing that. But this is going to be an easy way to figure it out because obviously the ETF is going to hold the 10 most popular dividend stocks, dividend companies within Australia anyway. So it's likely that it might be similar to what you would choose as a dividend investor anyway. But which one would have actually made you the most money in 2025? Let's have a look. So all of the data that I used in this video, I took from the 15th and 16th of December, so it should be pretty up to date, depending when you're watching this video. And I'm going to compare $10,000 in VHY compared to $1,000 in each of the top 10 companies. Let's look at growth first, and I'm going to assume just for this exercise that you purchased the stock on the 2nd of January 2025 because the 1st was a holiday. VHY increased 4.75%, so you would be up $475. Now the top 10 did pretty well overall, only a few went down. BHP went up 10.59%, Commonwealth Bank went up 1.22%, NAB went up 13.29%, Westpac went up 18.98%, ANZ went up 26.57%. It was a really great year for growth for banks. Telstra went up 19.85%, Rio Tinto went up 18.83%, Woodside went down 3.63%, TCL went up 7.78%, and Macquarie went down 9.07%. So overall, the average, you would have gone up around 10.44%, mostly because of the banks. So in this case, growth, choosing single stocks would have made you more money with growth only. But let's look at dividends. I just went in to check what they actually paid and based on how many shares you would have been able to purchase on the 2nd of January. VHY did really well, and we'll talk about that in a minute, but you would have made $884 in dividend income with VHY. But let's look at the single stocks. So BHP, you would have made just over $42, Commonwealth Bank, $31, NAB, $45, Westpac, $47, ANZ, $58, Telstra, $47, Rio, $50, Woodside, $66, TCL, Transurban, $49, and Macquarie, $30, which would have been dividend income of around $470. So dividend-wise, you would have made more with VHY than you would with the individual stocks. Now, this isn't usual. Oftentimes, I find the opposite. So I went and had a look at all of the companies within VHY to see which ones of those companies paid a really high dividend yield this year. VHY holds 76 companies, but the three that paid the highest dividend yield this year, and this is not to say that these are good investments as single stocks, they are just what paid the high dividends, was Nine Entertainment, NEC. They paid a 50% dividend yield. That is not usual for them. Helia Group, HLI, paid a 25.8% dividend yield, which is super high. I've talked about Helia before. And IPH paid 11% dividend yield. That is part of a reason why ETFs can do well with dividends, is because these outlier companies can sometimes just pay really high dividends. And because you have such a range of companies within that fund, that can pay off. But overall, if you look at both the dividends and the growth, single stocks slightly ahead. Your portfolio would have done $154 better with the single stocks, but that's because of growth and not the dividends in this case. But again, that's not every year, that's just 2025. There is something that we need to talk about though, and what does paid more actually mean for most investors? Now, this was just based on 1 year. over the long term, you're going to get very different results. Now, of course, because we're dividend investors, dividends are still going to be our number one priority, but you do need to take in both dividends and growth because we want both. But more importantly, you do still want consistency and reliability. Some of those outliers within VHY that paid a really high dividend yield, they don't do that every year. They just did it this year. So depending on what's more important to you, the answer completely changes. So here's my case for dividend ETFs. Now, dividend ETFs feel like a smarter, safer choice, and for many investors, that is true. You're going to get instant diversification, you're going to get lower company-specific risk, it is passive, low-effort income, and they often have more stable dividends given the range of companies within that fund. So let's talk about the case for single stocks, because this is where things get interesting. As a dividend investor, you'll be able to find those high-paying, fast-growing dividend stocks that has the potential that maybe you'll be able to outpace and outgrow the ETF and do better because you don't have the dilution of the weaker companies within that fund. You can be just choosing the best companies. Now, of course, this only works if you know how to choose individual stocks, and that is not for everyone. So now it comes down to your skill gap. How good are you at researching stocks and choosing good dividend paying companies? For a lot of investors, because ETFs are average by design, that is great, and that can be a great way to invest. Choosing individual stocks does come down to being able to research companies and find which ones are doing well. So you do need a little bit more knowledge when you're investing in individual companies. If you're able to choose good dividend paying companies, then you are going to outperform the ETF. ETFs are going to protect you from yourself. But stocks, choosing individual companies, that's going to reward you more over time if you know what you're doing. And I'm going to walk you through how I research dividend paying companies later in this series. But the overall answer to which one should you put in your portfolio, it depends. This doesn't have to be an either or debate. You can have both, you can have one or the other. Both are good. Perhaps you want to start with ETFs and then move into single stocks later. Perhaps you just want to stick with ETFs, and that's perfectly fine. So next week, we're going to focus primarily on dividend ETFs. I'm going to talk about how to research a good dividend ETF, and I will give you my top 3 dividend ETFs in Australia, the ones that I like the most. That way we can really delve into ETFs before we move into single stocks. I hope you've enjoyed this video. Take care and happy Christmas.